Apple stock has been the darling of many investors, including Warren Buffett, and it is the largest holding in his portfolio and is around 43% of his entire portfolio. And that means that the company has solid fundamentals. You can find tons of videos on YouTube justifying its viability as a long-term value investment, and many YouTubers and analysts are singing the praises of the company. But I have a very different opinion about Apple stock as far as the long-term outlook of the company is concerned. And people might hate me for that, and that is fine. And as you can see on tip ranks, based on 27 Wall Street analysts offering 12-month price targets for Apple in the last 3 months, the average price target is $192.42 with the high forecast of $215 and a low forecast of $161. The average price target represents a 10.06% increase from the last price of $174.83, and 4 analysts out of them are in the top 100 out of the 16,000 analysts on tip ranks, and not even a single analyst rates the stock sell. So how could I be not so excited? The first thing is that the ratings by analysts are meant to give you an idea of what could potentially happen in a very short time horizon. As you can see, the price targets are for 12 months in the future, and their success is gauged by these short-term predictions on the platform, and they are not meant to give you an estimate of the future growth potential of a company in the coming 5 or 10 years. So here is the thing, the devil is in the details. Price is what you pay and the value is what you get. Back in the day when Warren Buffett bought the stock, the growth prospects, the price compared to the intrinsic value and many other underlying factors justified it as a good value investment. But is this the case now? Will the service business of Apple grow to new heights? Will the iPhone sales keep on growing as before? So in this video, I will give you my own perspective about the Apple stock. People often forget that Warren Buffett bought the stock way back when it had a room to grow and was trading well below its intrinsic value, as I mentioned before. So we will do an in-depth analysis of Apple in this value-packed video, and afterwards we will validate our findings with the discounted cash flow model. So now might not be the right time to buy the Apple stock, as we will see later. So the future growth prospects of Apple are rather modest now. In today's video, I will go through the key numbers and some insights that will give you a different perspective. Nothing in this video is a financial advice. You don't have to follow my opinion or agree with points that I mentioned in this video. In their earnings report released 2 weeks back, the revenue was $123.9 billion, which was up 11% year on year and reached a new record. And that is not all. The sales of every product in their product portfolio except iPad hit new records. iPhones and wearables were selling at lightning speed, and this is not all. The services side of business also managed to bring in $19.5 billion of revenue. So all seems outstanding, but the company is overvalued beyond the shadow of a doubt, and we will explore why I think this is the case. If we look at revenue of Apple on product by product basis, iPhone sales continue to dominate and bring in most amount of revenue and is around 55% currently. So iPhone continues to be the main revenue generator, but its percentage has decreased in the past 5 years. As we can see, iPhones, iPad and Mac revenues are roughly equal, and the services side of business has shown significant growth in the past 5 years. The wearables revenue shows seasonality. For example, in Christmas, people buy them more as presents for their relatives and friends. Now, many investors believe that the services side of business is going to grow by leaps and bounds, and services definitely have higher profit margins. And the fact is that Apple services revenue in comparison to iPhone, iPad, and Mac has increased year on year. Some analysts see it as the most important segment of the company and can potentially reach $50 billion in profit by 2025. Also, Apple saw the number of subscribers to its services increase dramatically over the past 6 years. The stats include subscriptions to iCloud, Apple Music, Apple TV Plus, Apple Arcade, Apple News Plus, Apple Fitness Plus. So Apple's overall service revenue has quadrupled since 2013 and has increased from $15.8 billion in 2013 to a staggering $68.4 billion in 2021. And that is not all. The gross margins for services have grown to around 72%, which is brilliant even for the services side of the business. business. And going back to the figure I just showed, the profits and revenues are growing very fast and making a larger and larger portion of the overall profits. But here is the problem. The Apple sales have shown a downward trajectory and are going down with time. But the services revenue is growing since people are buying the apps and subscriptions. Now, unlike the Android Play Store, where any vendor can make use of the Android operating system and ship Android devices, Apple has a tight integration of the hardware platform and operating system with the goal to provide the best possible user experience. This is a double-edged sword though. Services revenue for Apple is strongly correlated with the iPhone sales in the long run, since if the flagship product does not keep on growing its installation base or user base, eventually fewer and fewer iPhones will be out there in the hands of consumers who will be installing the apps on their iPhones and subscribe to the services. Hence, in the long term, Apple does have this vulnerability which Android doesn't have. And the main reason for the Apple's hardware and software platform integration is the aim to provide the best end user experience to the customers. And this end user experience is mainly fueled by Apple's own processors that are the life and blood of the seamless experience that iPhone provides. And now here is the thing. Google has recognized it and seems to have taken away the competitive edge from Apple with its own in-house Tensor processor, which will power the Google's Pixel phones. Google's Pixel 6 has in-house developed Tensor chip. The phone outperforms its Apple rival in terms of camera quality and other features, or at least they are comparable. And this is just the beginning. In the coming years, not only Google's Pixel phone will erode the iPhone sales, since they will keep on fine-tuning Android operating system and the hardware to provide the best possible experience just like Apple. And the thing is that they have the financial muscle to do it. Billions of people use Gmail and YouTube and other services of Google already. At the same time, the Android can be used by any company like Nokia, Samsung and LG to provide their own custom look and feel to the users. This gives Google's Android and therefore its services business much more robustness, since as the Pixel sales will pick up, it will erode iPhone sales and the services revenue will keep on increasing not only via installation of Android apps on Pixel phones but also on Android phones from other vendors. Also, it seems that Google might be on the verge of jumping straight into the PC and tablet market, since the first step in this direction has already been taken by the development of its own Tensor chip that is powering its Pixel 6 phone. And now let's go to my custom developed investment dashboard so that we can see the feasibility score of Apple as a long-term value investment over the time frames of 10, 5 and 3 years respectively. These numbers and key financial ratios don't lie either. As the time horizon shrinks and gets more closer to current time, the feasibility score of Apple as a value investment drops. It is just 64% for the time frames of the last 3 and 5 years as compared to a staggering 86% over a time frame of the past 10 years. In past 3 years, the price to free cash flow is over 20. The equity growth has been less than 10%. Operating income growth has been less than 12% and ROIC has been going down too. And now let's have a look at the discounted cash flow model. Here are the results of it. Even with an overall growth rate of 12%, which is optimistic, a margin of safety of 25%, the discounted rate of 8% and growth decline rate of just 2%, and the last free cash flow multiple of 12, which is an arbitrary multiple at which you believe the company might be sold in 10 years time. And this is a necessary assumption for the discounted cash flow model to work. You can choose a value between 12 and 15 where 12 is more conservative and 15 is more aggressive. So with all these numbers, we get a buy price of $118. So Apple is definitely overpriced at this point, and I won't touch this stock with a 10-foot pole. You don't have to agree with me. This was an analysis that I did so that I can tell you my own unbiased opinion. If you liked this video, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it and it means world to me. You all are awesome, and as always, I will see you guys in the next video.